I want to welcome three very distinguished panelists who are, for lack of a better word, coming at this from a more academic perspective. And I don't know if you all have been following it, but we've had a panoply of different perspectives on Bitcoin. We've had investors, we've had people who work in the field, we've had alternative currencies, we've had some prosecutors who have dealt with some of the money laundering aspects. So we're continuing to try to get a 360-degree view of everything Bitcoin so we can make smart decisions when it comes to regulation of virtual currencies and Bitcoin, et cetera. So I know that between you, you have different fields potentially and different views, and we very much look forward to a robust discussion. And please don't hold back. These aren't like congressional hearings. They're designed to really probe the ins and outs of this fledgling industry and understand both the positives and the negatives. So we'll keep it fairly informal, except for as a technical matter, we always swear in the witnesses. So if you'll each rise and raise your right hand. Do you swear or affirm to tell the truth, the whole truth, and nothing but the truth, so help you God? Thank you. So why don't we start with, is it Professor Athey? Professor Athey, and we'll just go down the line.
So it's a pleasure to testify here today.
Oh yeah, you need to, I keep forgetting, you need to have the green light on.
Very good.
There will be bad consequences.
It's a pleasure to testify here today. I'm a professor of economics at the Stanford Graduate School of Business, and my recent teaching and research focuses on the economics of digitization and the internet. I also want to disclose that I have a formal advising relationship with a virtual currency startup called Ripple Labs, but today I'm here speaking on my own behalf and not representing the view of any institution or firms, and you can check out my other business relationships at my website at the Stanford GSB. In my remarks today, I will use the term virtual currency loosely to refer to those currencies such as Bitcoin, Ripple, and others that use a ledger to track balances of individual addresses together with cryptography to ensure that only authorized users initiate a transfer between addresses. So many people have focused on Bitcoin for illegal activities or as a store of value or for speculation. My view is that Bitcoin and other virtual currencies have many legitimate uses, and indeed they may lead to a wave of innovative activity that in financial services over the next 20 years and beyond. Much like the protocols that underlie the internet led to innovations that were difficult to foresee in the beginning, so the new protocols may allow new services to be created that benefit consumers, businesses, and lead to economic growth. But just like the internet, especially in its early days, was used for good, it was also used for darker purposes, and indeed some of the early adopters of the internet and the first to make money might have been focused on maybe the seedier sides of relative to what the internet's used for today. And so just like the internet, we need to make sure that it grows healthy in a healthy way and in a way that allows regulators to do their job. Virtual currency can be viewed as a technology that allows one individual to send money to another instantly, securely, and without a middleman. So at its core, what the technology really is it's a secure ledger. The idea of a currency is actually sort of an add-on, or it's not necessarily the raison d'etre for the technology. However, it's an integral part of the technology. So you might ask, well, if we can have a ledger that keeps track of addresses and who has what, why do we need the currency at all? And so part of the answer is, well, I can't literally beam a dollar from me to you. The currency is the way that you keep track of the ledger. It's the units of the ledger itself. So the currency is just a means to an end. That's the chits or the marks in the book that say who has what. Now, some newer protocols, like the Ripple protocol, actually allow multiple currencies to be accounted for in their ledger. Indeed, there's nothing stopping you from keeping track of dollar balances, airline miles, or another currency that you make up on these ledgers, and the Ripple protocol allows many such currencies to be tracked. But the native currency is sort of fundamentally different. The ledger might say that I have a United States dollar, but there has to be some financial institution or individual who maintains a balance sheet and promises to pay me that dollar if I ask for it. So the ledger can track my claim, but it can't enforce it. In contrast, if the Bitcoin ledger says I have a Bitcoin, the Ripple ledger says I have an XRP, the protocol itself specifies that I, as the owner of the address, can move it from me to someone else. So there's no third party, there's no counterparty risk involved with the native currency of the ledger, and that's what requires you to have this, this sort of third, this new currency rather than just have everything be denominated in US dollars. Of course, there's always a risk that something goes wrong with the protocol itself, but within the normal operation of the protocol, there's no counterparty risk. Of course, in today's world, the virtual currencies do have their own costs, the exchange rate risk from holding it, the fees and the on-ramps and the off-ramps, and of course some of those fees will persist as long as you're operating in a regulated economy where the people who change local currency into virtual currency have to understand the identity of their customers and comply with regulations. So we don't expect those fees to go to zero. However, the fact that this secure ledger allows for very low cost and instantaneous movement of funds lowers the fundamental costs of moving money and thus should lead to lower fees in equilibrium as well as entry and competition. So in terms of the use cases of virtual currency, I hope we'll have a chance to expand in more detail on many of these, but let me just sort of give a high-level view. Within the US, you can think about what happened when PayPal came. We got new use cases that had been locked out or priced out by the existing financial systems. If you had a fundraiser for someone who was sick, who had cancer, if you wanted to raise money for, say, the Leukemia Foundation, if you wanted to have a small business and accept funds, PayPal enabled new use cases of electronic commerce and thus it led to increased economic growth and entrepreneurship. But there's still parts of the market that are unserved. It's still very difficult to make small payments, less than about $1 you don't see very much because the fees are so high. And it's also, we expect to see more expansion in the US for use cases like micropayments for online services or news articles. Within developing countries, many people don't have access to the financial sector at all, and so in principle, virtual currency can allow people to have access to international financial markets, allow for remittances, as well as payments within developing countries that are cheaper, and remittance fees are quite high as a percentage, and they're very important for many countries. In terms of U.S. consumers, we also could purchase services internationally. Imagine language lessons given over Skype. That allow you to pay an individual without having all the money go to a middleman. Any kind of services that can be delivered electronically could also be paid for without the fees, which basically make it prohibitively expensive to do transactions under several $100s, and are still a large percentage even for moderate-sized transactions. Virtual currencies also are interesting within business scenario. Rather than accumulate potential trades throughout the day and clear them in the end to save fees, a multinational firm can send money to itself many times a day. So just in closing, the underlying technology of virtual currency unlocks a wide range of potential applications. Some of the possible applications I outlined, but I want to emphasize that we don't really know what the best use cases will be, and they probably haven't been invented yet. From an economics perspective, regulation should facilitate innovation and competition, as well as enable players in the industry to be able to accurately assess whether or not they're in compliance and give those players the ability to operate within a specified legal and regulatory framework. It should also create incentives for the kind of innovation that will allow the benefits to be attained without sacrificing the most important goals of regulation. Good regulation will lead to the industry to develop in the United States and to develop, therefore, in directions that are consistent with regulatory goals. But regulations that make it difficult to know if you're in compliance or just difficult to comply with might lead the industry to go offshore and might change the direction, probably in directions that are not as well aligned with U.S. interests. Thank you.
Thank you very much. We'll turn now to Professor Felton.
Thanks. Thanks for the opportunity to testify today. Let me introduce myself briefly. My name is Ed Felton. I'm the Kahn Professor of Computer Science at Princeton University and the Director of Princeton's Center for Information Technology Policy. And I served as the first Chief Technologist at the Federal Trade Commission. As we all know, money has been stored and transferred electronically for a long time. But virtual currencies are born digital, and so they offer potential advantages in security, efficiency, and new functionality. The new functionality part is especially exciting to computer scientists like me. We heard from the previous panel about some of the new types of secure financial mechanisms that may soon be feasible by integrating money and cryptography in a way that either eliminates or drastically reduces certain types of counterparty risk. The digital currencies of the year 2020 will be different. They will have more powerful functionalities than what we see today. But even in their current, relatively simpler form, virtual currencies like Bitcoin create new challenges for businesses, consumers, and for government. As we've heard over and over, Bitcoin is remarkably decentralized. There's no central issuer of the currency, and just as importantly, there's no authoritative rule maker who decides what is a valid transaction or what a valid block in the blockchain looks like. The system operates by consensus. And there are really three kinds of consensus that come into play. First, there's a consensus on which transactions have occurred, and therefore on who owns which coins. That's represented in the blockchain. Second, there's a consensus on what the rules are, which transactions could be valid, which blocks could be valid. And that consensus allows the consensus blockchain to grow and to record new transactions. And third, of course, there's a consensus that Bitcoins have value in the first place and therefore are worth owning. The genius in Bitcoin's design is that it yokes together these three types of consensus about the history, about the rules, and about value in a way that creates incentives that push participants toward joining and staying with the consensus that exists. So if there's a consensus that John Doe owns 72 Bitcoins, then there's an incentive for all the other participants to join that consensus and treat John Doe as the owner of 72 Bitcoins by following the consensus blockchain. If there's a consensus that some transaction violates the rules, then there's an incentive to join that consensus and treat that transaction as null and void. It pays to join and stick with the consensus, and so the consensus tends to be stable. And it's that trick of creating incentives to stick with the consensus which makes Bitcoin able to operate and maintain consensus even without a central issuer or central rule maker. Now, the decentralized and consensus-driven nature of Bitcoin has two major implications for government. First, there's an opportunity for government to help protect the mechanisms that maintain consensus, such as the Bitcoin blockchain. If consensus were to collapse, then Bitcoin can't operate, and that potentially causes great harm to the consumers and businesses that rely on the technology. And yet, the mechanisms that maintain stability of the blockchain are complex and subtle. They seem to work. And, but even after a lot of study, we don't fully understand their dynamics. For example, we don't know for sure what would happen if someone were to monopolize Bitcoin's mining mechanism. Government can help to deter attempts to manipulate or destabilize Bitcoin in ways like this. Second, the decentralized consensus nature of Bitcoin changes the options that government has available in terms of regulation. Bitcoin's not an organization, it's a consensus, and you can't call a consensus on the phone or have a meeting with it. No single actor has the power to change the rules of Bitcoin. So if you want the rules to change, the only way to achieve that change in practice is to create a consensus that the rules ought to be changed. This limits the power to regulate the rules or to set or control the rules of Bitcoin, not only the power of government, but the power of any single actor within the system, which is one of the reasons for its strength. But at the same time that it's difficult to change the rules, companies and people that use Bitcoin in harmful ways are already subject to prosecution, already subject to regulation, as we have seen. We're still very early in the development of virtual currencies. The technology offers great promise, and we can only start to imagine the opportunities that it will create. Everyone, I think, will benefit from a regulatory approach that works with the legitimate users and developers of the technology to foster innovation in this space while deterring or preventing harmful uses of the technologies. Thanks for your time, and I look forward to your questions.
Thank you, Professor. And we'll turn it over to Professor Williams. Thank you for being here.
Yeah, thank you. Good afternoon. My name is Mark Williams, and for the last decade I've been a finance professor at Boston University, where I specialize in banking and capital markets and commodity trading risk. In 2010, I wrote a book called Uncontrolled Risk about the rise and fall of Lehman Brothers, in particular, what caused that big real estate bubble. Prior to my academic career, I was a senior executive for a Boston-based commodity trading firm, and I also worked for the Federal Reserve Bank. I appreciate this opportunity to testify today, and for full disclosure, I have no direct or indirect financial interest in any virtual coin or Bitcoin sort of startup company. My discussion, I'm not going to focus on the promise of virtual currencies, as enough of that has already been discussed yesterday and also some this afternoon. But my focus is really to focus on the unaddressed risks associated with virtual currencies. Sound business and regulatory decisions can only be made when these risks and the benefits are measured against each other. In the last 5 years, the number of virtual currencies have exploded. Currently, are over 75 currencies trade representing $11 billion of market value. Bitcoin itself is $10 billion. It is the leader. By proxy, the strength and weakness then of Bitcoin is the strength or weakness of virtual currencies. And if we look specifically at what's happened with the high-profile arrests this past week, we see that Bitcoin still has a long way to go before we can rely upon it to be a mainstream transaction or even an investment speculation. Bitcoin is a virtual currency in name only. Since inception, it has shown extreme annual price volatility, which has topped 150%. On many given days, Bitcoin can fluctuate by 20% or more, making it unfit as a transactional currency. Price instability, uncertain tax treatment, and concentration of ownership, including by some individuals who were here in the hearing yesterday, has morphed Bitcoin itself into a virtual high-risk speculative commodity. Dangerously for investors, Bitcoin is a hyper-asset bubble that has begun to deflate. Since 2013, the price has gone from $13 to a high of $1,200. China's decision not to recognize Bitcoin as a legitimate currency was the pin that started to pop the bubble. Today, it trades at $790. Bitcoin prices have been artificially inflated through a cartel ownership structure, extreme hoarding, questionable exchange practices, marketing hype, and greater opportunities for market manipulation. Since December highs, Bitcoin prices have fallen 30%. As investors gain greater awareness of how prices have been artificially inflated, Bitcoin prices will revert back to 2013 lows, even possibly falling to single digits by June of this year. Bitcoin also lacks consumer and investment protection, making it problematic for broader adoption. Untraceable money makes it harder to solve crimes. As prices have skyrocketed and economic incentives for fraud has increased, there's been a recent increase in the amount of stolen coins, reported over 220 million that have been stolen and still unrecovered. Reputational damage remains high. Is Bitcoin an innovative response to facilitate meaningful commerce or a designer currency for the criminally inclined? The recent indication, or at least the indictment, of the Vice Chairman of Bitcoin Foundation for money laundering exposes an ongoing credibility problem with regulators, law enforcement officials as well. Poor reputation also stunts capital inflow and industry prospects. Banks remain hesitant to open new accounts or provide funding to Bitcoin-related startups, not simply because there's a lack of regulatory clarity, but due to perceived legal liabilities. The trust and integrity associated with the U.S. dollar as a transactional currency has been earned over centuries and supported by ongoing monetary, fiscal policy, soundness of central banking system, regulation, and of course enforcement. If Bitcoin in its current embryonic stage were to gain wider acceptance without appropriate regulatory controls and oversight, we could expect a proliferation of its misuse for unlawful purposes. Bitcoin as a fast and low-cost electronic platform system is highly innovative and provides much promise, but significant risks still need to be adequately addressed through regulation, better investor and consumer protection, and greater scrutiny as a high-risk speculative asset. In summary, I look forward to answering any questions related to concerns you may have about virtual currencies and, in particular, Bitcoin. Thank you.
Thank you, Professor Williams. What we usually do is I'll ask a few general questions to the panel, maybe a few specific questions, and of course my colleagues up here will also ask you some questions as well. Obviously there's a diversity of views on the panel, which is great. That's what we want. So not to provoke an argument, but to provoke a little bit, I'd love to hear the reaction from Professor Athey or Professor Felton to some of the strongly held views that Professor Williams has about, you know, the real dangers here. And look, to be fair, there are a lot of skeptics out there in the world. I can't tell you. There are many people who come up to us and say, it's great, Bitcoin is the future, but there are also many people who say, really? Bitcoin? We don't even know who invented it. It's someone whose name, it might be a group, no one knows, and there's no central bank behind it. And can we really have faith in this? And, you know, or are we making a mistake here? Is there, is this just a lot of people putting their faith into something that once they realize what it really is, it'll come crashing down? You know, is there a bit bubble, I guess would be one way to ask it. Do you, how do you respond to those skeptics?
Sure. So I can begin. I guess let me start with maybe the volatility and the value of Bitcoin. So it is true that exchange rate volatility makes it harder to hold Bitcoin and if you're going to be using it often then you would, for small purchases, you would like to hold a little bit of it. And so, therefore, as long as the volatility is high, it's going to be expensive for people to hold it in terms of risk. But actually, if you're going to use it as a transaction mechanism, you don't really need to hold it. And one of the things that the industry is evolving towards are ways to help people use it for transactions without holding the currency. So in the Bitcoin space, if you keep dollar value that's accessible to a Bitcoin exchange, when you decide to use it, you can at that moment buy Bitcoins, send them, and then the person on the other end can cash them out. So you only care about the exchange rate volatility in the 10-minute interval between when you buy the Bitcoin and you send it to your friend, who then cashes it out again or sends it to a merchant. So that at that level, although the volatility is still much higher than other exchange rates in that 10-minute time interval, it's much lower. And the Ripple protocol actually encourages you to hold your local currency, and you can actually confirm your transaction instantly, so that you're only holding the Ripple, you know, is only being held for a very small period of time, and in fact you have no risk at all. You know exactly how many yen or other currency you'll get out at the other end when you confirm your transaction. So the exchange rate volatility in that case is basically irrelevant, or it's not very important. It'll affect bid-ask spreads on the exchange market. So it doesn't make it, it certainly is a friction, but it's not impossible to overcome. In terms of, I'm not exactly sure where the prediction is that Bitcoin will fall into the single digits. Let me first address how concerned we should be about that. So I don't think that you know, my friends who are small-time investors should be holding Bitcoin. I don't think that poor people in developing countries should be holding a lot of Bitcoin unless their own currency is much more volatile than Bitcoin. So I don't think that generally this is a great investment for small investors, just like investing in Silicon Valley startups is also not a great investment for most small investors. They have a profile, a Silicon Valley startup has a profile that it might get very big, or it might go bust. It might go to zero. And I think that's a good way to look at an investment in Bitcoin as well. Okay, so how do you think about the value of a Bitcoin, the exchange rate between the dollar and the Bitcoin? Well, if you have a certain volume of transactions that's occurring through the Bitcoin network, and a Bitcoin can be used a certain number of times a day, that's the concept of velocity, okay, that's going to determine what the dollar value of Bitcoins needs to be in order to support the transactions. So if you have, if you had one Bitcoin and they're infinitely divisible and you wanted to do $1,000 worth of transactions in the day and each Bitcoin can be used 10 times, then the Bitcoin needs to be worth $100. Okay? And so the current Bitcoin prices could be consistent if you thought that the Bitcoin network was, soon or in the next year or two. You can be speculating on the future, but if you thought that the Bitcoin network was going to grow to support $100 billion worth of transactions or something in that range, if you had reasonable velocities, that would support today's prices, the exchange rate between the dollar and the Bitcoin. If you anticipate the dollar value of the Bitcoin is going to rise, then you go ahead and buy it now, and so the prices run up today in anticipation of the future transaction volume. That's fully rational. However, you might believe that maybe $100 billion worth of transactions won't occur over the Bitcoin network. They might occur over some other virtual currency network, or they might not occur at all, possibly because developed economies develop regulations in such a way that makes it hard to do that volume of transaction. And if that doesn't occur, the volume of transactions on the network will fall, and therefore the dollar value of a Bitcoin will also fall. But I don't think that one can naturally assume that there's no principles for the price dollar value of a Bitcoin, nor that it's wrong today. Personally, I think there's some risk that it will go to zero, maybe more likely that it's replaced by some other system over the next 5 or 10 years, but I don't have a crystal ball. I can't say when it will go to zero. I think many of the people investing now are pretty sophisticated investors.
And just so I understand, and that would happen under what scenario? That basically a better system would emerge?
Sure, a better. And I think one path where that could happen would be a system emerges that somehow is more compliant, makes it easier to comply with regulation, which would be a reason to switch. So generally, a lot of people are on Bitcoin now. There's no real reason to change. It does involve 10-minute delays, and it has the whole mining infrastructure. So it's got some downsides, but it's working reasonably well, and there's a lot of coordination on it. But if for some reason another system came along that had some technological advantage, it was faster, or it maintained identity better, or it did something else that made it easier for people to get a bank account, made it easier for people to operate a regulatory compliant exchange, you could easily see people transitioning to that new system. But I don't think that would be an instant, wouldn't necessarily be an instant collapse. It would take some time, and again, individuals who are just using it for small transactions presumably would be able to move their money. People who are holding $100 million worth of Bitcoin might have a hard time liquidating it in time, and they might lose some money. But in some sense, I'm not so concerned. Those investors are, a different category of investors.
Professor Felton?
Sure. I guess I'd like to say two things in response. One is that it's important to separate the personalities from the technology. Certainly some of the personalities involved in the Bitcoin space are, well, let's say, colorful. But nonetheless, there's a lot of legitimate business going on as well. And one of the strengths of Bitcoin, and the reason really it got off the ground at all, is that it operates on this consensus mechanism, which tends to insulate the technology itself from the personal adventures of individuals. That is, that those people who are in it for the longer run and are building infrastructure and trying to build businesses that have a business model and a compliance strategy are participating vigorously in this process of trying to evolve the system forward. And so I don't think it makes sense to write it off based on the behavior of a few of its cheerleaders. The other thing that I would emphasize is the benefits of virtual currencies generally. I agree with Professor Athey that although Bitcoin is in the leading position now, that it could easily be the case that some other virtual currency or currencies come along that have an important advantage either in enabling compliance or in technical efficiency to eliminate the inefficiencies involved in the mining process, or in terms of supporting more sophisticated, built, securely created financial mechanisms. New currencies that are more efficient in that sense, in any of those senses, may be able to take all or part of the market from Bitcoin, and that would be a positive development in the big picture to have more opportunities available. And then finally, I want to focus on the things that virtual currencies can do that traditional currencies cannot do. And we've alluded to this a few times, but let me give you one very specific and modest example. One of the forms of transactions that one might want to do involves escrow. So A wants to pay money to B, and for whatever reason, A wants to put the money in escrow until something happens, and then we'll release it to B. And so you can pick an escrow agent C, and A gives the money to C, and then C gives the money to either A or B at the end. Or that's what you hope happens, but of course there's the risk that C just runs away with the money or goes broke or something. One of the things that the Bitcoin technology already lets you do is build an escrow mechanism which does not allow C to run away with the money. You can in effect create something that's kind of like a voucher that can be paid to B or back to A, but those are the only things that can be done with it. And have that be contingent on something happening? It would still be the judgment of C, which of those, it would still be C's decision which of those two things would happen. But the one thing C could not do is walk away with the money themselves. And it's possible to do this in a way such that the Bitcoin blockchain mechanism that already exists enforces this. So that eliminates a risk of misbehavior by C, of certain kinds of misbehavior by C that would have existed before. And that's a kind of financial technology that you can't build without, in a natural way, without having a digital currency to start with. Escrow is a relatively simple example, but you can imagine taking more complicated forms of contracts or financial relationships and encoding them into technology in such a way that they are self-executing in some sense. And that's a field which that is a door that Bitcoin is only just starting to open. But I think that's going to be an important trend going forward. And one of the ways in which another technology could dislodge Bitcoin from its position is to be considerably better for that kind of purpose.
Professor Felton, yesterday we heard one of our panelists talk about colorable coins. Is
Yes.
this sort of what you're talking about?
That's another example,
Okay.
right? It's a way to sort of bind something else of value to some tiny fractional Bitcoin. This is this idea that once you have a public consensus public ledger in which you can write things, then new sorts of functionality become possible.
Professor Williams, do you want to react to any of that?
Sure. So what Susan did say, there is a scenario where it could go to zero, and I think that's an important point. What we know is there's lots of uncertainty in this environment right now. We know uncertainty equals risk. We also know that this commodity, this virtual currency, which trades like a commodity, moved by 9,000% at its height last year. Now, it started the year 2013 at 13, and at the peak in December it was 1,200. So are you telling me that the value proposition changed that dramatically between the beginning of 2013 and at the end? There's other things that are pushing the value of this currency up, and it's market inaccuracies in the sense of whether it's manipulation or whether it's artificially pushed, reducing supply and artificially increased demand. But a 9,000% increase should wake everyone up. It's not something you typically see in a commodity.
Thank you. Let me ask a related but different question. And I think, Professor Felton, you've written about this, but I want to delve a little more into it. How worried should we be when it comes to Bitcoin about the protocols or codes, whatever you want to call it, being corrupted in some way or worse, taken over by someone or some country with what I understand would have to be a lot of computing power, but that at least if it was a foreign country intent on bringing down a system, let's say if it became more ubiquitous, how worried should we be? Is that a real possibility? And what should we do about it?
Well, there a couple of ways, if you want to spin out hypotheticals, in which there could be a sort of grand technological failure of Bitcoin. One of them is a failure of the fundamental cryptography on which it's built, digital signatures and so on. But if that technology fails, then all of e-commerce is in danger. Bitcoin is not our biggest problem. So let's focus instead on something that's specific to Bitcoin, and this has to do with the mining mechanism. And what you're referring to, I think, is a scenario in which, well, so let me back up. One way of thinking about the mining mechanism is as a kind of voting process. When I talked about consensus, about the history, you can think of mining as a kind of voting process in which miners cast their votes by doing computation, by solving mathematical computation problems on behalf of a particular proposed a block to go into the blockchain. And the more
Which would represent a transaction.
to represent a set of transactions.
Okay.
And the more computing power you bring to the table, the more votes you have, in effect. And the stability of the system relies on there being a diversity of different entities that are involved in that mining. And so there is the possibility that someone comes along and makes a very large capital investment to build more mining power than all of the existing miners have. What would that cost? It's a little hard to tell, but it's at least in the hundreds of millions of dollars. If someone were to have a majority of mining power within Bitcoin, then they have considerable power to change the rules. They have more than half the votes in this voting process about what the future history will be. And so you can imagine that if there were some, let's say, hostile nation state that wanted to destroy Bitcoin, they could, in principle, by investing very large amounts of money, get the capability to do that. One thing that seems to be the case now is that there's not a greed-based scenario in which that kind of attack will work. That is, if someone is going to invest hundreds of millions of dollars in order to build Bitcoin mining infrastructure, and they want to maximize their return on that investment, the best way to do that is just to be a really big Bitcoin miner and not to destroy the system.
How do you detect that kind of attack coming?
I think there are a couple ways. One is you would see a sudden increase in the amount of mining activity. Okay. Now, that's a thing that sometimes happens naturally. Bitcoin mining is now, let's say, $1 billion a year activity. That means that there is a lot of research and development and new technologies for mining coming online, and they lead to rapid increases at times in the amount of mining power. The other thing to note is that whoever, the hypothetical attacker here, would be making a pretty substantial capital investment. And that would probably be noticeable. There are companies that build Bitcoin mining chips. The attacker might make a large buy of those. And so you might see market activity that indicates it. Once this, the other thing to say is that if this form of attack starts, you would know immediately that there was funny business with the development of the blockchain. There are lots of people watching the blockchain for indications of deviations from the expected behavior, and right now we don't see them. And so you would know pretty quickly that this was happening.
And what could you do to stop it?
That's actually a quite complicated question. What you would try to do is you would try to have the legitimate members of the Bitcoin community simply ignore the mining activity done by the attacker. To the extent you can tell the difference between which proposed blocks in the blockchain came from the attacker and which one came from the normal miners, you would simply try to ignore the attacker. You would just agree to ignore the attacker's blocks. The question is whether the attacker could masquerade as a member of the community and maintain that masquerade over time, and I don't know whether that would work or not. I don't think we know. There are a lot of question marks associated with this scenario of someone getting majority mining power. Right now, that hasn't happened, and the community is watchful for situations in which there seems to be an accumulation of mining power under single control. And if that ever happens, there is a lot of discussion and people back away from that brink.
Let me just add one thing from a risk perspective. We did have something like that happen last month. We had a group collectively called themselves ghash.io, and collectively, to gain greater computing power, they connected with each other, and as a result, they became one supercomputer. And the concern was they were going to gain 51% control. Right after the event, they put out a press release saying that wasn't their intention to get 51% control. But the point is the fact that this group could is very concerning.
What did that do to the price at the time?
Well, the price volatility continued. I mean, it moves by about 20 to 30% a day. So I could pull that out and say that event that day moved the price up or down.
If I could just comment on that very quickly. In thinking about this issue of control over mining, there's a phenomenon called a mining pool, which is a bunch of smaller miners who cooperate. And they cooperate mostly in order to share risk. So that there's an inherent risk involved in mining because you don't know if you're going to be able to find the next block. It's kind of, mining is more like a lottery than it is like a certainty. Groups of miners often choose to pool their resources. But it's one thing to say that we are choosing to pool our resources. It's another thing to say that we're acting as a cartel that will deviate from the rules of the system in a coordinated way. You could have a mining pool that is more than half of the mining power, but consisting of a set of small individuals who are not likely to collude. So the real question is, do you have a majority of mining power that's either held by one entity or a small group that is willing to act as a cartel?
Yeah, I just had a few kind of big picture economic points about this whole thing. One point is that as the value and the importance and thus the macroeconomic risk associated with Bitcoin and other virtual currencies grows, the cost of these attacks also grows. So you think a couple $100 million, but what would that really accomplish today? So it would make a bunch of sort of rich people who are holding a lot of Bitcoin poor. That would be sad for them, but that wouldn't really be sad for our economy. And not very many individual investors would really be harmed by that at this moment. A second point is, but if it gets more important, it also becomes more expensive. And we sort of have a fair bit of time before that happens. A second point is about the protocols. So the mining, it's very interesting. It's beautiful. It's intellectually elegant. It was a lovely solution to a bunch of problems at once. It allows you to distribute the currency in a very structured way, so it doesn't get dumped on the market all at the same time. It allowed the market to grow. It also captured the interest of early enthusiasts and really helped the ecosystem grow. Much as Beanie Babies got people interested in eBay early on, which helped it grow to be a vibrant marketplace that allowed a lot of entrepreneurs to start businesses, the mining and some of these other things really got people interested early on and helped it grow. It is not a necessary feature of a virtual currency to have this complex mining thing, and sometimes there's a trade-off between sort of complexity and elegance and simplicity from a regulatory perspective, and I think the mining, it's just so hard for everyone to understand that that is one reason you could imagine another system coming along that's just easier to explain, even if it is in some ways less elegant. And then that kind of also leads to points about sort of multiple platforms. So I think it can be, it's easy to think in these markets where you have a lot of network effects, Bitcoins are more useful if other people have Bitcoins, and, there's a first mover advantage and you're just going to have one system. But actually there's lots of advantages, lots of examples of technology platforms where there are multiple platforms coexisting. There's many reasons that can happen. That can happen because they're differentiated. Say one platform is better for one kinds of transaction, another platform is better for other kinds of transactions. We have multiple credit card companies. We also have PayPal. These things can coexist. And so it could be sort of healthy. You can imagine that as this develops, as it grows, it's not just all the eggs in one basket, but that different platforms are out there serving different needs, which also leads to less macroeconomic risk around just one platform. And again, I think we will have lots of time to see these things grow as they become a more and more important part of the economy. We can develop the regulation and the safeguards along the way. Right now, it's just, it's just sort of negligible in the size of the U.S. economy.
When you say that there are these other options and other potential types of virtual currencies, one question that's come up in the previous panels a couple times is some of them, as I understand it, have this public ledger, and some do not. It seems from a regulator's perspective or a law enforcement's perspective where there is sometimes a need to dig down deep to find out what happened with a particular transaction or who was involved, especially in the case of illegal activities. What is your perspectives, I guess I'll ask the whole panel, of whether we should move towards a system where we want to encourage or even require that if we're going to have virtual currencies, there be a public ledger versus one where there's not?
So, I mean, I think it's dangerous to try to make regulations sort of too specific from a technology perspective. I think it's more about the functionality. But it seems like, a key functionality is that if a financial institution exchanges, say, bitcoins for dollars, that it knows where the bitcoins are going. That's actually not possible today. You can't know. You can send bitcoins to an address, but you don't know whose address that is. And that's very challenging from a compliance perspective, because even the first hop out of an exchange, the identity of the recipient cannot be verified. I think the Bitcoin community is developing new modifications to the protocol that allow metadata to be associated with transactions, and one can imagine that either a third-party service provider or embedded in the protocol, the combination of the two, some third-party service provider and changes in the protocol, would allow you to verify the identity of the recipient of a transaction. Okay, and so then at that point, just like when you take cash out of the ATM, the person put in their PIN and you had a video camera and you know who took the money out of the ATM, you also would know where the bitcoins went at the first stage. So, I mean, it seems reasonable to favor technologies that allow you to verify, the identity of the recipient. At the same time, saying it must be a public ledger might be a little bit strong, because there might be other ways to accomplish the goals. But when we think about the specific technologies, I do think it's important, if you required that, every hop, 10 transactions down the line be traceable, that's a requirement that's very different than what we require of an ATM transaction or of any other type of financial instrument. You can't, once you turn something into cash, I can give the cash to whoever I want to, and there's no electronic way to track it. So I think that, personally, I think we need to be careful about having sort of parity across these different things and not make extra requirements that go far beyond what we require in other contexts.
Sure. I would agree with that. A public ledger is one of the approaches to solving one of the fundamental problems in designing a virtual currency, which is when someone wants to give you currency, how do you know that they actually own it? And one way to do that, obviously, is to have a public ledger, but there are other systems as well. But generally speaking, this design requirement that people can know who has which money, or at least that the money that someone is offering to them actually is real and has a legitimate history in the system. Whatever solution a particular technology has for that problem is, I think, likely to offer an opportunity for, say, law enforcement to follow the money if they need to.
I think the challenge is that when we think about Bitcoin, if we had a blank piece of paper today and we said, how can we create Bitcoin to be meeting the demands of the future, would it look exactly the way it was built? And I think the answer would be definitely no, for a number of reasons. Number one, the volatility issue continues to haunt Bitcoin. How do you reduce volatility? There's many coins out there now. coins now are starting to charge a fee. So if you don't use it, it's more expensive. So it tries to increase the velocity and use of it as a transactional currency. That's a wonderful idea. We've also seen changes in regard to sort of this issue of how can you make it more credible. Don't make it so mysterious. Although in a sense Bitcoin does a good job of putting the source code and making it very public, there's other issues that appear very secretive about it. In regard to looking at, for example, the supply, different coins have different mechanisms to create this supply. So I think there's a lot of best of breeds that can be learned. My concern, of course, is the fact that Bitcoin itself is over 90% of the market value. So in essence, hopefully this won't be a Bitcoin world driven, but we'll get the best of breeds. Eventually we will have e-currency. I mean, what would stop, for example, one of the weaknesses of all these e-currencies is there's not a balance sheet supporting the underlying currency. So what would stop, for example, a Google of coming in and saying, hey, I'm going to do a Google currency, in essence, and I have this balance sheet, I have the market name, I have the credibility. No one's going to think that I'm going to be involved in money laundering or try to do tax evasion. So, hey, I have a leg up. So I think there's a lot more sort of growth. I think Bitcoin is still definitely at the infancy. And again, we still need to focus on these risks and not just on how unique and technologically impressive it is. I think we have to say, well, what is the risk? What could go wrong? And how could that hurt the economy?
One thing we heard on the law enforcement panel this morning was about the use of tumblers. And it was me questioning a prosecutor, and I think between the two of us, we probably could use a little education from all of you to the extent you can explain. Certainly to the extent we were talking about it on the law enforcement panel, it sounded like there weren't a lot of good uses for tumblers. And it might be something we should think about either scrutinizing very closely, maybe banning, to think about the kind of from what we heard, it sounded like a tumbler could really be used to really thwart law enforcement's efforts to get behind some of these transactions when there are illicit activities. So I wanted to get your reactions.
Well, I think that the tumbler or mix technologies exist really as a reaction to the privacy implications of a public ledger. And of course, there are lots of reasons why people might want to hide from public view how much money they have or where it came from. Obviously, one such reason would be because that money is the fruits of criminal activity. But there are plenty of other reasons just having to do with not wanting the neighbors to know how much money you have or what you paid for your house, or I guess that one's public anyway, but and so on. So I think it's a almost inevitable side effect of a public ledger that there will be technologies that people will try to use to cloak their affairs because they're not accustomed to living in a world where the size of your bank account is in a public ledger, and every investment you make, every buy or sell is in some public ledger somewhere. So I don't think it's right that, I don't think it's correct that there are only criminal uses for these technologies. But certainly they do have uses by criminals, and they can frustrate law enforcement.
I think I would just go back to say that if you have say an exchange that has a U.S. bank account, that exchange is really going to value the banking relationship, and that bank is going to be very concerned with compliance with financial regulation, and they're going to want to know their customer, and they're going to want the exchange to know where the money goes when it goes off the exchange. And I think that creates a very strong incentive for everyone to develop the ability to monitor identity. And people who want to participate in the exchanges lawfully and are happy to pay taxes and are in fact concerned that their participation in this economy could somehow have negative consequences for their own personal or professional life would welcome the opportunity to participate in a more transparent way. You can also imagine that services would arise to allow you to take the second hop from like the public identity, public ledger to a sort of, more private identity entry in the ledger where, you know, it's very difficult for your neighbor to look up your balance, but it would still be possible for law enforcement to do so. And so, again, if you can sort of envision, and it doesn't exist yet, so I'm sort of talking speculatively about what a company might invent, but a company could easily invent sort of an address book for identity that could be matched up with metadata in the Bitcoin blockchain, which will be out within the next month or two, and people are discussing this. And then it could be that an exchange will only allow you, an exchange with a U.S. bank account will only allow you to operate on the exchange if you have an account with this identity verification system, which then is compliant with law enforcement. Now, at some point, you'll be able to leave that system. You'll be able to then take once you have your Bitcoin in your address that's verified in this identity system, you might be able to take it out of that system. And at some point, people might leave the ecosystem with lots of identity information. But at least if you know about the dollar values coming in and out, you've got a pretty good handle on, you know, the financial activity that's going on, and you have a starting point for law enforcement. You have a digital trail to begin with. So, you know, and of course, even starting to use tumblers and other things, it leads various other digital footprints. You know, you get online to look for these things. You know, you have activity on your phone. It's very difficult, not impossible, but it's difficult to disguise all of your digital footprints. And so, in some sense, this has some advantages over pieces of paper scribbled down and cash.
It's exactly what we were talking about at the break, is there a way to have the system develop in such a way, or to incentivize the system to develop, where you have enough information for law enforcement and to prevent money laundering, which we all agree we want to do, but at the same time allow people at other stages in the chain to have more financial privacy, which has a lot of potential good benefits. I mean, I don't think any of us love the fact that when we buy something online, we get 6 emails 5 minutes later marketing related products to us. It's clear that whoever you just purchased from knows a lot about you and has just sold it to 5 other people. So, but that, you're saying the technology is not there yet to do that, but it's developing?
Well, and I think that organizations like yours can have a big influence on that, because what's the carrot? What is the carrot for everyone to put their energy into developing that versus all the other business goals? If they can get a bank account, okay, that's a really big carrot. And how will they get a bank account if the banks understand that certain actions they might take would put them in a very safe position from regulatory risk perspective? So I think, you know, if you have a bunch of diffuse goals and all of the institutions and businesses involved don't really know what those goals are, they don't know how to invest their time and attention. But if there's a few sort of specific goals that people agree would kind of really advance the regulatory cause, you might see a lot of innovation and activity lined up around those goals.
It is, as a technological matter, it's possible to build technologies that are accountable in that way. Or you might end up simply relying on institutions, which, just as with a bank today, I can have a payment made on my behalf, but it's made by the institution so that it's not totally obvious to, say, my business competitors that payment, that I was paying a certain amount. But nonetheless, that institution knows that payment was made to a certain party and on my behalf, so that could be followed if necessary.
And I just want to emphasize again that I think when you think about the law enforcement, if you have a handle on the big movements of sort of, in the U.S., dollars in and out of the system, you're going to, that's a big step. Knowing exactly how smaller payments are made may be less important than seeing the dollars coming in and out. And so, you know, trying to have identity sort of completely pervade the whole system is a goal that may be beyond what any system, you know, can achieve today. But having the big steps occur is important. Another aspect of the privacy, I think, that's important to think about is that, you know, with the credit card system, you're giving your information to a merchant, which is one of the risks we see. I think that we can imagine that these virtual currency technologies can evolve to be more of a push technology, where I just send you the funds for a transaction, but I don't need to tell you everything about me and my address and my code on my credit card and everything else. I'm just going to send you money. And so, at that point, it's safer from a consumer protection perspective because they're just going to send you the funds. They're not going to give you access to all of your financial information. And that really kind of cuts down on the information flow, and every time the information flows, there's a risk. If the consumer is holding their funds in an account that's associated with some financial institution, that institution would be regulated. You would see their money going into that account. Presumably that financial institution would also want to do business with merchants who also have bank accounts who are also regulated. And so, you can easily see that just having like a one-hop requirement of identity could lead to a situation where a lot of the legitimate uses are sort of covered, but without having to expose as much information publicly or among institutions that can be hacked.
I have a question about fees. Professor Athey, you touched on this in your opening statement, and one thing that we keep hearing about virtual currency and Bitcoin is that the fees are very low. And that makes sense in the peer-to-peer where I just send coin directly to your wallet. But as companies build up around this and as an infrastructure comes into place and their compliance costs and renting office space, won't fees necessarily rise? And then what will that do to fees with other payment processors?
Sure. So, obviously it's impossible to completely predict the future, but a framework for thinking about this is to, fees are composed of two things. They're composed of costs and profit margin. Hence, you think, why are fees high today? Why are fees what they are in credit cards and other sorts of financial services? Why does it cost me, $25 to send money the same day between two U.S. financial institutions that are major when I'm a big customer? Why is that fee so high? Is that all costs? Does it really cost $25 for me to wire money from Bank of America to Fidelity? Probably that's not the actual marginal cost of that transaction, and that's not required. They already know me as a customer and so on. We can expect that some of that, the profit margin part of that fee, which is the combination of profit margins of the intermediary and the banks themselves, will fall. In terms of the actual cost perspective, you are, and the delay perspective, some of that is sort of the technology, the clearinghouses and so on. These things are decades old. They were. You might say, well, why haven't those modernized? Like, what's wrong with us? Here we are in 2014. Like, why can't we move, money instantly and cheaply already within the existing system? And so you can think of that as sort of partly inertia. It's difficult to coordinate a change. Everybody has computer systems that are all set up for the current system, and various people benefit from the fees and the fact that these complicated systems create barriers to entry and so on. So what do I think happens when you have innovation? The more nimble existing financial institutions cut their costs, cut their fees to compete, and maybe they develop their own protocols using similar technology but customized for themselves and bypass the clearinghouses. You don't need the clearinghouses. Technologically, we don't need them. So they should not need to use them. And that can cut down fees and delays. We also can imagine that, depending on the regulatory regime, that you could have entry. We're sort of decoupling certain services, right? So right now you hold your balance in a bank, and you also use that to make payments. If you start decoupling services, some of the old assumptions about economies of scale and barriers to entry might change, and you could have new entrants coming in and competing away the sort of profit part of the fees. So sort of to summarize, some of the actual costs, some of the costs are due to delays, and some of the delays are due to the use of technology that's obsolete. Some of the costs are due to just inefficiencies, and some of the costs the fees are due to profit margin, and we expect all of those to shrink. Go to zero? No, because firms, if they're going to bring dollars into this ecosystem, must know their customers, and they must verify identity. And they must have systems in place to flag transactions and do various other things, and that does cost money.
Has anyone ever tried to quantify what those costs are related to dealing, for example, with Know Your Customer and other things like that?
So I'm not I've tried to dig into that a little bit, but I'm not an expert on that.
Yeah, Dana, to answer your question, well, there's two forces on the fees. So we could either look at the existing structure fees, Visa, MasterCard, for example, at 3%, or we could look even at Western Union at 5%, or we could actually look at Bitcoin. Now, what we learned from the indictment this past week, they were charging fees as high as 9%. So in essence, when Bitcoin comes in and we talk about low fee structure, let's say it starts at 0%. When we have Visa competing in MasterCard, these forces, these competitive forces, will push the fees, and the consumers will be better off. So I see it actually two forces pushing and ultimately lower fees. Now, the third force is venture capitalists. As they come into this environment, in this ecosystem, they want return. They need annualized returns of at least 25% to be interested. Andreessen and Horowitz, for example, they're the largest investor in this space. They recently put in $50 million. That wasn't altruistic. So how are they going to get that return? Now, we know one of the founders mentioned that he's not going to invest in Bitcoins. He has a de minimis amount of investments. He's going to focus on where he can make money, and that's Bitcoin-related services. So it's this whole idea of structuring and commercializing this. So, when we have these debates and we say fees are going to be virtually zero, that's not true. There's got to be profit built in the system for these folks to be interested in it.
So one of the reasons that fees are likely to increase is that there will be services that consumers and businesses actually find valuable that help them interface with this technology, right? I mean, if you're a merchant who wants to accept payment in Bitcoins, you can do it by getting Bitcoin wallet software and installing it on your servers and making decisions about key management and et cetera, et cetera, et cetera. There's a lot of integration. There's security and hacking risk and all of this. Or you can hire a service that gives you a pay with Bitcoin button you put on your website, and they take care of the rest in exchange for a fee. And that service provides value, and people will be willing to pay for it. There's likely to be competition to provide those services to businesses and to consumers to help them hold and manage and secure the digital currency. But as long as those are competitive businesses, then the fees should be relatively close to the actual cost of providing the service.
And just in terms of, thinking about the overall, profit opportunities in this business from the investment perspective, you have to remember that maybe there's net new customers being served that weren't served by the existing financial system as well. Again, just like PayPal created transactions that just wouldn't have occurred. You just wouldn't have donated $10 to your friend. You wouldn't have donated $2 to the Red Cross without PayPal. It's just not worth your time to write the check and put the stamp on the envelope. But when you have an easy, low-cost way to do things, new things happen. And again, new businesses that get a cut of that will have, will profit if they have a small percentage of it.
It sounds like what you're also starting to touch on is micropayments. And I guess this question would be for Professor Felton. As micropayments take off, what happens to the verification system? Does it become more cumbersome and will take up a tremendous amount of bandwidth? And that's where I'm going.
Sure. Well, there are two ways that could go. So imagine that there are a lot more people want to make a lot of small payments. And this has been an issue in the Bitcoin system already, so-called dust transactions that involve very small amounts. And there are two ways that can go. One is that you have the blocks in the blockchain get really large because they have so many transactions written into them, and that generates technical costs for all kinds of parties. But another thing that can happen is that some kind of institution or company comes along that is an intermediary for these transactions, so that they aggregate them into a smaller number of larger transactions that get put into the blockchain. And I think that's the thing that's likely to happen, if there is pressure for space in the blockchain because of sheer number of transactions, that you'll have intermediaries that do this aggregation in exchange for some kind of fee. What happens then essentially is that space in the blockchain, the ability to have a recorded transaction in the Bitcoin system, now becomes a scarce resource. And so there is some bidding for that space through a mechanism called transaction fees. And that creates an incentive for people to aggregate transactions. And companies, institutions can come along to do that. I think that's a likely future if one believes that there will be an explosion of a large number of very small transactions.
I wonder if I could, I'm sorry, Professor. I wonder if I could just draw in, into the conversation some of the points that were raised over the past couple of days. And it's really focusing more on the short term rather than the potential horizons. We heard today from retailers and from exchange wallet companies. And yesterday we heard from the investors. And the great hope is that quickly you will have kind of peer-to-peer transactions for retail goods. What is the impact in the short term that that's going to have on the liquidity of Bitcoin? Because yesterday we learned, we talked about this earlier today, a lot of Bitcoin is held by folks who are speculating at this point. If in the short term there is a kind of explosion in usage, one of the answers we received this morning was, well, Bitcoin is infinitely divisible. But that, and maybe I'm wrong on that, but that sounds like dilution in a very significant way. And I'm wondering whether that that's going to have a significant impact both on valuation, volatility, and just really ability to conduct business.
So I guess I can speak to that, and that goes back earlier to what I said very briefly about sort of how you value a Bitcoin. So sort of in equilibrium, so imagine that we have, we're stable, nobody thinks the system's going to grow, then you can basically take the volume of Bitcoins that are actually in circulation by people wanting to spend them as opposed to people just holding them. But the amount in circulation, we can look at what the dollar value of transactions you want to support. You look at the velocity, like how many times they can be used per day or per year, and you come up with what the dollar value of Bitcoin should be. So if today's prices reflected sort of today's steady state transactions, okay, and you had a tenfold increase in transactions, then the dollar value of the Bitcoin should go up exactly in proportion to that. Now, I think if you looked at what's sort of gone on with it's kind of hard to understand really what's happening in the last year, because whenever anything's nascent and people are kind of coming into it for a variety of reasons, things aren't necessarily reflecting a steady state, but they're reflecting beliefs about the future. Until the price went up to 1,000, there was some relationship between, the transactions on the chain and the dollar value of the Bitcoin. Then that kind of moved out of whack, and I think if you wanted to make a rational explanation for it, it would be that people were anticipating that over the next 2 years, we will see a bunch of retailers accept it, we will see a tenfold increase in transactions, therefore we expect the price to have to go up by tenfold to support the dollar volume of transactions. Therefore, the price goes up today, because if you can't expect a price to increase in the future and let it stay where it is now. Okay? So in some sense, the price may already be reflecting the belief by speculators that the dollar value of the transactions will go up. As the dollar value of the transactions goes up, those speculators no longer believe it's going to grow so much in the future. The speculators start to sell their Bitcoins. They bought them at 1,000. If they become worth 10,000, then they sell them. And so those market forces will sort of naturally cause the speculators to start to actually let go of their Bitcoins and sort of keep the prices in check. So that's why I'm not sort of too concerned. I think market forces will sort of take care of that to some extent. And it's also, in some sense, it doesn't really matter what the dollar value of the Bitcoin is. It matters if a bunch of individuals are holding it and it falls, as a factor of 10 overnight, then those people are sad. They lost their money. But actually, the next day, if it was stabilizing again, people would wake up and they could use it as a transaction mechanism again. And I would say that small investors, you shouldn't put any money in Bitcoin that you can't afford to lose. You shouldn't hold large amounts of it. And if you do, you realize it might go away.
That relies on the ability to do your transactions relatively rapidly, and you talked about that earlier,
Yeah.
so you're not holding it in that interim.
Right.
How confident are you that as we see Bitcoin develop, if it develops over time, that we'll continue to have that quick transaction time.
I think if you don't, then people will move to other systems. I mean, it's a real cost to, if the exchange rate is fluctuating, it's a real cost to have that delay. Somebody has to bear that risk. So you would see middlemen come in and try to bear the risk on behalf of consumers. And then if you did see a middleman taking those big positions, those bigger institutions, I think you should be concerned about what their reserves are and whether they can meet the promises that they've made to consumers, because they would be facing real risk. And I think that gets back to the earlier point. This is a risky asset. So if you have someone that's holding a lot of it and promising that money to individuals, you do need to recognize that, you know, there's some chance they could lose their, if they're holding a lot of bitcoins to meet their obligations to consumers, if they're not diversified, they could go belly up. And so the bigger institutions are kind of they're making those promises, I think, should be evaluated as being quite risky.
Okay.
Right. Now, the risk that Susan mentioned is very important. So she's correct. It's sort of like a hot potato. If you could take the risk and pass it to someone else, it's not that the risk goes away. It gets concentrated by who's holding it. And that we're already seeing that in regard to looking at those service providers which are allowing people like Overstock.com to avoid price risk. Overstock officially, you know, markets and say, hey, we don't accept, we take Bitcoin, but they don't unofficially say we don't take price risk. They allow, for example, Coinbase or, for example, BitPay to take that on directly. And that's very important because, in essence, what's happening is we're having concentration risk of Bitcoin, high volatility, within two entities. And these two entities are undercapitalized. So, in a sense, imagine that on a micro, moving it to a macro scale. We're going to have concentration risk, and ultimately the risk resides somewhere, and someone needs to manage it. Right now in the market, there's no, for example, derivatives market. Typically, in a very mature market, we have derivatives that allow people to hedge and mitigate that risk. That's not the case here. So it's a real concern. I think the other thing that we should not do is say, well, because Bitcoin is trading at 800, that must be the market price. You know, I think we have to look at the underlying and say, well, Bitcoin at the beginning of the year, 2013, was 13. Even up to, for example, October, it was under 100. Then all of a sudden in October it went to 200. And then in December it was 1,200. Has the value proposition changed? Did it change so much in 2 months to be that high? And I think ultimately what we saw in December when China came forward and said, we're not going to accept this as currency, it dropped by 400, and it's off at this point by that $400. So we can say that as other events occur and the uncertainty becomes more certain, it's going to be priced into the value of this commodity. And so I think we're at sort of the second inning of this. You know, in Bitcoin life, I think 1 week is a decade, and so a lot will unfold in the next hearings like this are quite helpful. But that underlying fundamental problem of Bitcoin remains, and that is it has high volatility. Unless we can manage it and understand how to get it down, then that is going to be the Achilles heel, and it's going to avoid this currency from being adopted.
So can I just say, though, I mean, if this is where, like, getting more financial institutions into the system, I think, can be really helpful, because if you had a way to, you know, I don't want to wire my money to this Slovenian institution and have them holding it in, you know, a foreign bank ready to buy Bitcoins. Like, I would rather keep my money right here at my local bank account and then only move it when I need to. So, like, you know, Coinbase has set up this ACH system, and it's backed up by your credit card. So I can just keep my money happily, my US dollars happily in my bank account, knowing that if I want to, I can very quickly purchase a Bitcoin and then use it for a transaction and be done with it. So that's encouraging me to keep my money, my US dollars, first of all, keep my value in US dollars, and second, keep my US dollars in a nicely regulated and safe US institution, and not leave my money floating in these other systems. If you have it, but if you don't have a lot of, if you make it hard for the U.S. banks to actually plug in easily, that's going to encourage people to transfer their money and hold their U.S. dollar balances in these institutions who are themselves exposed to the the Bitcoin exchange rate fluctuation risk. So you don't want to have a lot of dollars sitting in Coinbase, basically, because they could easily end up in a bad situation if something happened very quickly and they weren't managing themselves properly. But if you have the dollars in the U.S. bank account, the risk to our financial system is not that great, because if everybody has like $5, $10, $20, some leftover change sitting in Coinbase, but everything else is in their U.S. bank account, if they go belly up, you know, it's just not, it's not a big deal from an economic, a macroeconomic perspective. And then similarly, one of the reasons I found Ripple interesting was that they actually do encourage you to hold your balances in your local currency and can completely abstract from the virtual currency if you choose to. And what's lacking to make that operational is to have a bunch of U.S. banks be able to plug into it. If they're connected, there's no reason to take your money out of the existing system.
Don't you have the length of time and costs built into the transfer from your credit card or U.S. bank account into the Coinbase wallet? It just sounds like you've I don't know, added another layer to the multiple levels of.
That's right. So you do have the ACH fee. Now, you can do a slower ACH transfer, so a 3-day transfer. It's backed up by your credit card, so they don't actually charge your credit card unless your ACH doesn't show up. So it's just that they've gotten all your identity information. You've given them, you know, a backup to make sure that you can pay, and then you can go ahead and buy your Bitcoins and transact with them, and they'll wait for 3 days for the money to show up. So this is not a perfect system, okay? But if you had, you know, if you had a deeper relationship between the banks and these institutions, you might not have to go through ACH at all, because your money would be flowing back and forth and you could find other ways to do it. But I think right now it needs to be arm's length because none of the U.S. banks want to have a deeper relationship with the. So I guess the big point here is that a more predictable regulatory system that gave the banks confidence that they could integrate more closely without facing huge risk would actually diminish the macroeconomic risks associated with this institution, because it would encourage people to keep their money where it is and only take it out when they need it, rather than trusting some inherently riskier institutions.
It's funny, yesterday we heard a lot of testimony about sort of banks bad, Bitcoin good. Today, this is the second panel where we've heard having the banks move into this area would actually be a very good thing for everyone. So it's
well, so I think this is partly, you know, this is reflective of the evolution of an industry. I mean, you know, personally, you know, my interest in this is much more about how this is going to change the existing U.S. economy. I think some of the early enthusiasts in this space were more focused on disruption. I think, you know, disruption is great when it brings consumer benefits and innovation, but the financial sector is so challenging that I think practically it's impossible for large-scale disruption of the type envisioned by the early enthusiasts to occur and within the regulatory framework. It's just so hard to comply with all of the financial regulations. And so my personal belief is that if we can get the expertise and the institutional horsepower that we have out there in the existing system behind, you know, more integrated, that's the path that's more likely to succeed. It's just going to be very hard to just from the outside disrupt and be compliant.
How do you get the banks and their sort of chief risk officers to feel more comfortable to kind of engage in what you're talking about, more about sort of partnering?
Well, so I mean, I think in this gray area, you know, they can come up with a plan, and then they're going to sit there and say, who's going to, you know, 2 years from now, is somebody going to come back and fine me for what I did today based on what they've decided 2 years from now? The banks are going to worry about whether or not they've complied. And so I think if there's a process by which they can say, this is our plan, can somebody please sign off on this plan? And basically, you know, agree that this was a good faith effort to comply with all applicable regulations across all government agencies today, if they could sort of somehow, through a combination of letters and submitted filings, get themselves in a position where, of course, they're still subject to risk and execution of the plan, but the plan has in some sense been approved. And I understand that the government, so many agencies, you can't really make that promise, but you can get as close as you can to making that promise, and in a way that if you were then subject to court proceedings or regulatory hearings later, you could come back to this plan and say, look, you know, we did our best, and everybody agreed that this was the best we could do at this time. I think that's kind of what they're looking for, an ability to say, you know, to kind of cap the huge risks of major fines or major, you know, major regulatory problems or getting accounts frozen or things like that, because they're willing to take on the risk of execution, but they need to know that their plan is okay.
Just add one thing to that. So I was a former chief risk officer, so I could speak a bit about how risk managers, especially in banks, think. When I actually worked at the Federal Reserve, we would do the same. You look at the risk versus the return. At this point, it's not just regulatory driven, meaning that regulation is not what's stopping banks from saying yes to e-currencies, it's their behavior. So the e-currency, this entrepreneurial behavior, which, you know, it's high risk taking behavior, but with that culture has also come this underbelly, which has diminished the reputation, in particular Bitcoin, which has made banks not want to get involved. So it's really just as soon as Bitcoin is willing to change its behavior, it is the driver for the industry. So as Bitcoin's success, it'll be the industry's success, and bankers will come, and then bankers will see the profitability, and they will put capital in, the infrastructure will grow. But the challenge here is three things. We have regulation, we're saying that probably will come to the industry. We're saying bankers will come to the industry. We're saying Wall Streeters will come to the industry. And we're saying risk managers. These are four things that the creators of Bitcoin never envisioned. So this is a complete sellout to this group. So in essence, the question really is to get this thing implemented. Are we going to have that sort of risk management discipline that's required that is basic to good management within banking and within our financial system, because we need to rely on it. You know, currency is our lifeblood. It's the strength and weakness of our economy. If we can't rely on the integrity and trust of the currency, if the currency moves in value by 20% in a given day, it's not currency. It's not going to be used. It's going to be hoarded like it is today in e-currencies. So we have to move away from this hoarding, and there's got to be stepping across the aisle. I mean, bankers have to step across the aisle too. It's got to be both ways. But I think it's going to be very useful to have more of these discussions, and hopefully in the end we will have policy and we'll have incentives for banks to get more involved.
I think Mr.
Sure.
Professor Felton.
Well, certainly in talking to consumers and businesses who are thinking of dipping their toes into the Bitcoin waters, one of the key frustrations they have is the lack of connectivity between the place their money is in the banking system and the Bitcoin system. If my neighbor asks me, how do I have some dollar, I have $100, I'd like to turn them into Bitcoins and try buying something, what should I do? The answer is not simple. It's a continuing source of frustration for customers, for consumers, and it's a continuing source of frustration for merchants and Bitcoin businesses. So anything that can be done to move along the conversation about how to integrate these things in a responsible way, I think would help everyone in the ecosystem.
I think, Professor Williams, you said earlier we're in the second inning of the game, and we heard testimony yesterday, I forget which witness said it, that sort of broke it down into phases and had a sort of innovation phase, which happened a year ago, and we're finishing up now a venture capital phase, but then I think he predicted that this year, 14, would be the Wall Street phase. Do any of you agree, disagree with that?
Yeah, I would agree. I think we're going to be shifting very quickly from the B team and to this experience level within the financial markets. If this truly is going to be the payment system, then it has to look and act and walk like bankers. In essence, again, there's a culture clash here. And will that actually be implemented? And will it be successful? But there has to be this strong risk management banking framework for that trust to come back in the industry so it can grow and benefit consumers. I mean, ultimately, this has the potential to benefit many consumers globally. The question is, will it be able to grow and have that discipline wrapped around it or not?
So, I mean, I think, again, if you think from the perspective of the banking industry and the financial sector, they are going to look at the risks and the returns. And if if it's just too complicated and too risky from a regulatory compliance perspective, then they won't invest. And if they don't invest, we don't get their A teams involved in guiding these businesses. So that's really where I see from the regulatory perspective where you can make a big difference. If you figure out how to engage, you will get the industry to evolve in a way that draws on the expertise of the businesses. And again, if you're looking to have control and information in your current regime, connectivity, it may seem counterintuitive that connecting the banks to this system is going to help you control it rather than let it get out of control. But my belief is that it will indeed help you control it, because everybody's going to want, it's going to be a huge competitive advantage to be plugged into the existing financial sector, and people will bend over backwards to make the whole system evolve in a way to do that, if they see it's possible. If they see it's impossible or too expensive, it's going to be 5 years, you have to apply for this and apply for that, and that takes 2 years, and then you don't know what the return is on the other end, and you might get shut down or fined or be, you know, hauled into court, whatever, then you're not going to invest. And then this is going to, I think, evolve much more offshore. And it's going to evolve in some sense. If this is mainly for outlaws, then it's going to evolve to serve outlaws, and the innovation and money will be directed more in that direction than into bringing it into compliance. So I do think it's a pivotal moment, and you should really take seriously the role that your decisions and collectively the whole regulatory infrastructure will take in what direction this heads and where the money and brain power goes.
I think there are a lot of people in the technology side of this sector who would like to link up to the banking system, who would like to be in compliance with regulation and responsible behavior, but are frankly frustrated at the difficulty in doing so. I think they feel a temptation to take that sort of offshore, try to stay under the radar kind of approach. But that's not a good outcome really for anybody.
Well, look, I think we're unfortunately out of time. We could probably go another hour easily, at least I could. But I want to thank all three of you very much for some very insightful testimony. The hearings have been really interesting. We've heard from investors, alternative currencies, money transmission experts, law enforcement, the retail side, the wallets, and now from the academics. So we take it all very seriously, as you mentioned, Professor, and we're obviously moving towards some kind of regulatory scheme. We're going to try and move as quickly as we can. We're not going to drag our feet, but at the same time, we want to be thoughtful and not make any mistakes. So we've got a lot of work to do on our end, and we'll probably be in touch offline with all of you for more good advice. Thank you very much. These hearings are concluded.
Thank you.